Welcome to efinanceacademy.com. The topic that we have for today is financial reporting and analysis. That's the new subject that we are actually starting. It's one of your most important topic in level 1 with 15% weight in the exam. Just like ethics, which has 15% weight, financial reporting analysis is too one of your heavyweight topic with 15% of your exam. So you need to make sure that you understand the concepts really well. As in level 2, you will be going, you will be advancing to another level in the same subject. So the way I have structured it, before we get started with each reading, we are going to discuss some fundamental and basic concepts of accounting, and I'm calling this accounting intro. So we'll try to understand some really important concepts before we get started with all the readings. And these concepts you need to know, of course, for the topics that are actually coming up. So as you can see here, the subject is named as financial reporting and analysis. It's not called accounting, although the subject is actually accounting, but in CFA, the CFA Institute doesn't call it accounting, and there is a reason why actually they don't call it an accounting. Here is how you can actually understand this. So when it comes to accounting, the first step is when you see an accountant, a bookkeeper, what an accountant does is they record all the transactions that actually happen, whatever bills they pay, whatever amount that they actually receive. So all the transactions are recorded in an accounting system. And this process of actually recording all the transactions is referred to as financial accounting. So it's actually the process of recording all transactions. And that's what you will actually see a junior level of accountant would actually be doing. Once these transactions are recorded and aggregated in the accounting system, all these transactions and all this data that has actually been gathered would be used to prepare summarized reports, and the process of preparing and publishing the financial reports is called financial reporting. So this is actually the process of preparing and publishing financial statements, in short FS, such as income statement, which is profit and loss statement. You have balance sheet, you have cash flow statement. We'll be talking about each of these statements in more detail. In fact, we have an individual reading for each of these statements. So we will have an extensive discussion later on. Once these reports are published, which summarize all the data that the accountants actually gathered over a period of time, then the users of financial statements, such as investors, lenders, suppliers, government, would actually take these reports and analyze them so that they can make economic decisions, so that they can decide whether to invest in the shares of the company, whether to buy, whether to sell, or for the lenders to actually decide whether to lend, for how long to lend, and so on. And the process of analyzing in order to make economic decisions is called financial analysis. So if you notice in CFA, the subject is not called accounting or financial accounting, rather it is called financial reporting and analysis. So the stress is mainly on understanding the financial statements, and the reason why you need to understand is, of course, if you want to analyze those financial statements, first thing is you need to understand what is being given to you in the financial statements. So the CFA Institute stresses more on reporting and analysis. So you're not expected to know exactly how the accounting is done, how the double entry is done, the T accounts that the accountants actually use, the trial balance, and so on. All that stuff you need not to worry about. Rather, you need to focus on understanding the financial statements and analyzing the financial statements. All right, so whenever the accountants prepare financial statements, in a company, of course, there are, you can look at a company from two perspectives. There is a company which has its own identity. It's registered company, it has its own identity. And then there are also owners, or actually investors, that own equity interest in the company. So when looking at accounts, you can look at a company perspective or you can look at the owner's perspective. But here is what we need to understand. Whenever the accountants prepare the financial statements, they always take the company perspective. What I mean by that is there is a basic concept that you need to understand, and that is called separate legal entity concept. And as per this concept, a company has its own entity, has its own identity. So it's separate from the owners. And when we do accounting, we do actually accounting for the company. And because a company has its own identity, the company can own assets like vehicles, it can own different types of assets, buildings under its name. It can also borrow under its name. So because of its own identity, I repeat, it can own assets under its name, it can borrow under its name, it can pay back the loan under its name, and the owners have a separate identity. So when we prepare financial statements, we actually prepare financial statements for the company. So we are going to see, for example, how many assets does the company have, not the owners? How much borrowings does the company have? How much is the profit and loss that the company actually made? And that's how we prepare the accounts. So that's the concept we keep in mind when preparing the accounts, which is the separate legal entity concept, meaning a company has its own identity. So the accounts or the financial statements are actually prepared for the company. And then the owners take those financial statements in order to analyze the financial statements. Then the next concept that you need to understand is called prudence concept. As per the prudence concept, it says that the accountant needs to be prudent in that if he or she believes that the company will face a loss in the future, and if it's a recurring loss, then the accountant should not wait for the loss to arise, rather should provide for that loss immediately in the accounts in the form of provisions or allowances. For example, let's say if you have noticed that on average each year 5% of the customers are not able to pay you the money. So 5% of the customers actually go bankrupt. And say in the current year you have had credit sales of say 100,000, and because 5% of the customers you have noticed always go bankrupt, that means you should keep a provision or an allowance of 5%, which will be called as provision for doubtful debt. So 5% of 100,000, your provision for doubtful debt would actually be around 5,000. So what you are saying is you're suspecting that out of 100,000, around $5,000 of the receivables from your customers will actually go bad, and you're going to record this as an expense based on the estimate. So if you foresee a loss, you don't wait for it to happen, you actually provide for it immediately in the form of either provision or by creating an allowance. So these are two important concepts, and you will see the applications of these later on when we speak about provision for doubtful debt, provision or allowance for goods returned when a company sells goods, and so on. All right, so having understood these two basic concepts, there are of course more concepts as well. We'll be discussing them. They'll be coming in the reading, but these are the ones that you don't find explicitly, but it's important to actually understand these before we get started with the readings. Some other stuff, some other basic stuff that you actually need to know are the different types of accounting equations. Again, you may not see all of these equations explicitly, but ultimately you'll have to remember them. Here and there, you will often see that these accounting equations would actually appear. So we have a statement which is called income statement, which is profit and loss statement. It actually presents profitability of the company. That's why it's called income statement. And in the income statement, since it presents profitability, and the profitability of the company is actually calculated as revenue, you may call it revenue or you may call it sales. This is actually the income that the company earns from its core business operations. For example, the company might be selling some goods, the money that it earns from the sale of those goods or from the sale of any services that are core part of its business operations would actually be called revenue. So a phone manufacturer, when the phone manufacturer sells phones, the amount it earns from the sale of phones would actually be called revenue. From the revenue, we subtract expenses, which is the amount that is actually spent in order to generate sales, such as marketing, sales, production, admin, etc. And once these are subtracted, then you get your profit. But there is also another income, which is called other income. So we said revenue is defined as income earned from the sale of your core business activity. But if you're also earning income from your non-core business activity or non-core operations, such as for a phone manufacturer, if the phone manufacturer has made investments in other companies and is earning dividends or is earning interest or may have rented some property and is earning rental income, then all this would actually be defined as other income because it is not coming from the main business operations. And then once you actually net this out, you get something called net profit, net income, or net earnings. Different names could actually be used. This is a very simple way of actually looking at the income statement. So this is the profit that the company has actually earned. Let's say this profit is 100,000. Now the question is, what happens to the profit? So in public companies, the board members would often sit and decide how much dividend would be paid, and dividend is actually defined as the distribution of the profit of the company. So whatever is the net income, part of that would actually be distributed as what we call dividend. So let's say the board decides that they want to distribute 40,000 profit out of the 100,000 as dividend. So where will the rest of the profit go? Of course, the rest of the profit would be reinvested back into the business in order to fund the purchase of maybe long-term assets, or in order to fund the expansion plans or fund growth, etc. So the rest of the profit is called retained earnings, because that's retained back into the business. That's, let's say, 60,000. In short, we can call this RE. Now, one thing you need to know, whether it's 60,000 or 40,000, both of these belongs to the owners. It's just that 40,000 has been given to them, and the remaining claim that they have, which is 60,000, has only been put back into the company, which is retained earnings. And since this profit, which has been reinvested back into the business, belongs to the owners, therefore, which later on we'll talk about another statement which is called balance sheet. In the balance sheet, this will be part of owner's equity, which is owner's actual investment. So the retained profit, which is reinvested, will actually be included in owner's equity, meaning this profit actually belongs to the owners, or sort of this is an investment that they have made by reinvesting their profits, or the profits that actually belongs to them. And this should become more clear once we understand equity when we go to the balance sheet. So generally, this is how you will find the income statement, and this is how the net profit, which is the bottom line, is actually linked with the balance sheet. So let's now look at the balance sheet equation. So this was the first equation we actually talk about. The next equation that we have is the balance sheet equation. What is balance sheet? Balance sheet actually tells us about the financial position of an entity. If you see income statement simply tells you how much is the surplus profit a company actually earned. It doesn't tell you, it's not a wealth statement. It doesn't tell you how many buildings, how many cars, how many properties does the company actually own, how many borrowings the company has. So all this information, which is more like, we can call it like a wealth statement, income statement doesn't actually present to you that information. It just simply tells you the net profit earned over a period of time. So for us to see the wealth or the financial position of a company, we look at another statement called balance sheet, which is also called statement of financial position under IFRS, because it tells us about the wealth position of a company. So the balance sheet mainly presents three things: assets, which is the wealth or the resources that the company actually owns, such as buildings, cash, money it expects to collect from customers, which is called account receivable, inventory, properties, machines, furnitures, vehicles, etc. All these are assets. And keep in mind, we're saying these are assets owned by the company. As we said, a company has its own identity. Now the question is, where does the company get the funds in order to buy its assets. So these assets have to be funded. A company doesn't have its own funds. It will get the funds for the assets from somewhere else. And the company can get the funds for the assets either by borrowings, which are called liabilities, or it can take the funds to buy the assets from the owners, which is called owner's equity, or in short, just simply equity. In short, what we are saying is that the company funds its assets by either borrowings, which are called liabilities, or by taking a contribution from the owner, which is actually called owner's equity. So you will always find that the balance sheet should always balance out. That means the left side, which is assets, should always equal to the right side, which is liabilities and owner's equity. The left side tells you about what the company owns, while the right side tells you about where it actually got the funds from. So how much you own and how much funds you got should both actually equal. All right, and here is a simple way to actually prove why this equation should always balance out. If it does not balance out, that means there is an error, and the accountants actually need to correct that error. So let's say you are the owner and you started a business. Keep in mind that a company is separate and the owner is separate. So you injected, let's say, $100,000 investment or capital into your business. Or you got the business $100,000. Let's put it this way. Where did you get the 100,000 from? You borrowed some money. So you took a loan, which is actually 40,000 for your business. And you put the remaining from your own pocket. So the remaining is what you have contributed as capital. The 60,000 is what you have put from your own self. So now the company has got 100,000 in cash from the owners. So the total amount that it has got is 100,000 cash. Where did this 100,000 come from? 40,000 came from the borrowing. So 40,000 is the debt, or you may call it as liability. So we are going to write 40,000 as a liability. And the remaining 60,000 comes as a contributed capital from the owners. So that's where we would actually record the 60,000. So the equation should always balance out, and that should become more clear as well when we will look at some further transactions later on. All right, so let's elaborate on owner's equity. When we speak about owner's equity, if you look at the same formula, the equity or the owner's equity can actually be calculated as assets minus liabilities. Meaning, think of it like this. Let's suppose if a company liquidates and closes down, then it will sell all its assets. And let's suppose it has assets worth 100,000. When it sells all its assets, suppose say 100,000, then first thing that it will do is it will pay off its liabilities. And let's say it has 30,000 liabilities. The leftover assets will actually go to the owners, and that is called owner's equity, which is $70,000. So if we are to define owner's equity, we could say that equity represents a residual interest in the assets of the company, meaning residual here means leftover interest. So a leftover assets actually belong to the owners, and that's how we say that equity is actually the residual interest in the assets of the company. Commonly, equity is also called as net assets because it is after subtracting or after paying off the liabilities. All right, so that's one way of calculating the owner's equity. Another way, if we look at the owner's equity and if we break it down, the equity can actually be broken down as equity is made up of contributed capital, which is the money that the owners have contributed. So let's suppose if you see the equity here, it's $70,000. Let's suppose the owners invested $50,000. So the owners had contributed or injected $50,000 into the business. Then where's the remaining 20,000 coming from? Over the years, the business reinvested some of the profits. So the board decided that they want to reinvest some of the profits, and the profits that have been reinvested over all the years since the start of the business until today is called retained earnings. And the total profit retained in all the years, let's say, is $20,000. And as we said before, retained earnings is more like it's a profit that belongs to the owners, but it has been put back into the business. So that's more like the owners actually reinvested their profits. Hence, it should belong to the owners. And that's why we actually added to the equity. So it's contributed capital plus retained earnings, which amounts to around 70,000, is what actually belongs to the owners, or you may call this as owner's equity. So that's how owner's equity is calculated. Now, one more thing we need to understand, how do we actually calculate retained earnings over the years? So let's talk about now retained earnings. All right, so let's put it this way. Let's say the business started here, which was time 0, and up until we don't care about what was the time, or let's put it some time. Let's say it started on 1st January 2011, and let's say until the end of last year end was 31st December 2015. So that's around 5 years in total. The total amount of profit that was retained until the end of last year was, let's say, $15,000. And this is the current year that is going on, which is from 1st of January 2016 until 31st of December 2016. So in the current year, we get to know from the income statement that the company earned a profit. As you can go back, let's say the company earned a profit, a net income in the current year of around, say, $10,000. So the current year profit that has been earned throughout the year is around $10,000, and the board decides to pay dividend, which is a distribution of profit of $4,000. So where did the rest of the profit go? It has been reinvested back into the business from the current years of profits. That's around $6,000. So we can say that the $6,000 is actually the current year retained profit. Now, if I ask you, how much is the total amount of profit that has been retained from the start of the business, which is from 1st January 2011 until today, which is 31st of December 2016? So in short, what we are saying is this: how much has been retained from here until right here? The answer would be, of course, in the current year, you retained 6,000, while in the prior years, you had retained 15,000. So 15 plus 6 would give you 21,000 has been retained until today. In short, here's what we are saying. We can calculate, or we have been already given beginning retained earnings for the year 2016. What do we mean by beginning? Which is the profit retained from the start of the business until the beginning of 2016. That's around $15,000. How much profit has been earned in the current year, which is net income? We have earned $10,000. But out of $10,000, how much dividend was paid? $4,000 was paid. So when we subtract 10,000 minus 4,000, we get 6,000, which is the profit retained for the current year added to the beginning retained earning. And that gives us retained earning until the end of the current year, which is around $21,000. So this is the profit retained from January 2011 until December 2016. So this is an important equation to actually remember. That's how we would get the retained earnings over a period of time. Keep in mind, this number is different because that was a different example. So don't think that why we didn't get the same number. All right, so now one thing we derive from this is that in accounts, whenever we speak about any account, you will always find that all the accounts are based on a base concept. So they are always based on what we call base concept. Base concept is actually, you will always have a beginning value, then you will add something, so there is addition, then you'll subtract something, and then you will get the ending value. As a simple example, if you look at your bank statement, you'll have beginning balance, then you'll have inflows, which are like deposits, which are added, then outflows are subtracted, and that gives you the ending balance. And that's exactly base. You have beginning balance, addition, subtraction, and ending value. In the same way, if you look at a company's cash position, you might say you have beginning cash, plus you have inflows minus you have outflows, and that gives you ending cash balance. Another example we could look at is something called account receivable. So just to tell you, if you don't know what is account receivable is money you expect to collect from your credit customers. Meaning you have sold goods on credit without receiving cash, and you expect that this is the amount you would actually collect from your customers, and it is actually your asset because it's something that will come to you in the future. So let's say up until the end of last year, you expect to collect 10,000 from the customers. In the current year, you sell more worth, which is credit sales. Let's say you sell more worth 5,000 on credit. So now you have to collect around 15,000. And during the year, some of your customers paid you, so you collected cash. So cash collected from customers is around 4,000. So you got 4,000 from the customers. That means all in all, you still have to collect around 11,000 from your customers, and that gives you ending account receivable. Again, we took the beginning value, we added something, we subtracted something, and that gave us the ending value. Our next topic is accounting for transactions. So we look at some transactions and we will try to see how these transactions actually tend to affect our balance sheet equation. So we're not going to look at the double entry as in debit and credit, but we are actually going to study the impact of these transactions on our balance sheet equation, which we know is assets equal liabilities plus equity. So whenever a company pays a bill, so a bill is an obligation. So if I have not paid, let's suppose a telephone bill, or if I have not paid a rent, so it is my obligation, it's a liability on me, which means we have already created a liability. So when I pay a bill, we are actually settling off a liability. We're paying off the liability. So when you pay off the liability, of course, your cash, which is your asset, would go down. And since you settle the liability, you'll have to close or cancel the liability. So in that case, your liability, which will most likely be a payable account because you did not pay it, you didn't pay the bill, so it was a payable, and that will go down and it will cancel off. And that's how you will actually account for paying a bill, and this will be the impact on the balance sheet, and overall your balance sheet will stay balanced. When a company issues a bond, issuing a bond is borrowing money, and here is how you could look at this. There are two parties. There is an issuer and there is a bondholder. The issuer can be an organization, a company, it can be a government as well. So the issuer issues a bond, which is like a certificate. In return, the bondholder buys the bond, which means the bondholder gives cash. So the bondholder can be thought of as a lender, while the issuer can be thought of as a borrower. By issuing the bond, a company is actually borrowing money. So how would we account for this? Or what will be the impact of borrowing money on the balance sheet equation? Because cash is coming in, therefore the cash of the company will actually go up, which means under assets, cash will go up. And since it's borrowing, where is the fund coming from? We know the right side is actually our source of fund or fund providers, which is liabilities, debt, and equity. Since it's coming from the borrowings only, therefore we'll create a liability or a loan under the liability, and the overall accounting equation will actually remain in balance. Okay, let's look at the next transaction, which is making a credit sale. So how do you account for a credit sale? If we complete this transaction, let me complete this because this is actually missing some information. So let's say a company owns inventory worth $800. So this is the cost of inventory, the cost of manufacturing, buying raw materials and manufacturing it. By the way, you should know what is inventory. Inventory actually represents any goods that the company has actually purchased or manufactured in order to resell as part of its main business operation. So manufacturer of phone, the inventory would actually represent the phones that are in the store with the company. Either they are finished products or they're work in progress, or it could actually also be the raw material. So let's say a company owns inventory worth $800. That's the cost of it. And it sells for $1,000 on credit. So that's how we could actually complete this. So you're selling an inventory that you already own. And when you own an inventory, that's your asset. So you already own an asset at a cost of $800, but you sell it for $1,000, and the profit you actually make is $200. So here's how we would actually account for this. We own an inventory which we are selling, so inventory is going out, so we would cancel the inventory by the amount of 800 because this was the value of the inventory, or this was the cost of the inventory. But do we get the cash when we sell? No, we don't get the cash. We are selling it for 1,000 on credit, which means we are not receiving the cash. However, we will create another account called account receivable, which is the amount of money we actually expect to collect from the customer to whom we have already delivered goods. So we create another asset. In short, that's called AR, that's your account receivable, worth 1,000. We expect to collect 1,000 from this credit customer. How much is the profit which will come through the income statement? Which is around $200. And if you recall, if I take you back a little, we said the profit from the income statement flows into retained earnings, and retained earnings is part of owner's equity. We saw that right here. Retained earnings is added to contributed capital to give you equity. So this $200 will flow ultimately into the retained earnings, which is a part of equity, by the amount of $200. Overall, your balance sheet will remain in balance. The left side is going up by net amount of $200, and the right side is also going up by the net amount of $200. Let's look at some further transactions. So buying materials is on credit. That's your inventory, as we know, when you buy materials. So assets equals liabilities plus equity. Your inventory will go up, and since you did not pay it, you'll have another account which is your liability, and often this is called accounts payable, which is what you owe to actually your suppliers. Again, your balance sheet will remain in balance. Issuing stock or issuing shares. Again, when a company issues shares, the company is the issuer. It actually gives shares to the investors, which are the owners. And the investors buy shares by giving cash to the company. So by issuing shares, a company is actually raising money. And here is how it will be. So cash comes in. Where did it come from? Did it come from the borrowing or the owner? It will actually come from contributed capital, which is equity. So that will go up, and your balance sheet will remain in balance. Next transaction is incurring an expense, not paying an expense. So for example, let's say you rent out a building and for a year, and you have used the building for the entire year, but you have not yet paid the rent. Or you actually subscribe for a telephone service and you have used it for, let's suppose, a month, but you have not yet paid it, but you have already incurred it because you have already used the service. Now you owe it, it's an obligation. So when you incur an expense, actually you have to record that expense because it has already been incurred and you've already taken the services or the benefits. Since you have taken the services or the benefits, you have to recognize an expense. And we know that when you record an expense, what happens to your profit? When you record an expense, your net income will go down, which means your retained earnings will go down, and overall impact on the balance sheet would be your equity will go down. And we can write that down. When we record expense, we want to see the impact. When we increase expense or record expense, then our net income goes down, then our retained earnings goes down, and ultimately on the balance sheet, equity would actually go down. That's the impact of incurring an expense or recording an expense. So let's now see the impact on the balance sheet equation. When you incur an expense and you haven't paid it, that's an obligation, therefore you'll have to record a liability. It will go up. And since we've already recorded the expense, what happens to the equity? We have not yet paid it, so cash position will not be affected. Our equity or retained earnings will actually go down. Overall, your balance sheet will remain in balance again. When you pay off a liability like loans, etc., here's what will happen. Cash goes out. And of course, because you have settled the liability will be canceled and liability will go down. That's how it would actually be. All right, here we have an extremely important concept that we will actually end this lecture with, which is accrual accounting versus cash accounting concept. So when accountants prepare accounts, they actually assume that they're using accrual accounting as opposed to cash accounting. And cash accounting is mainly used by governments. Accrual accounting is actually based on the concept that transactions should be recorded when they occur as opposed to when the cash occurs. So transactions should not be recorded only when the cash happens in the transaction. For example, I might sell good on credit. Now this is a transaction, but there is no cash involved. Under a cash accounting system, you will not record this transaction because there is no cash received. However, under accrual accounting, you will record this transaction because it has actually already happened. The transaction has happened. So we look at the details, and we look at the details of transactions related to revenue and related to expense. So the question arises is, when should you recognize a sale or revenue? And let me give you three options. And I want you to think of it and give an answer. So let's suppose you're a company and you sell goods. The question is, when should you record your sale? And I give you three options. Number one, when you receive an order from the customer, or when you receive cash from the customer, or when you actually deliver the goods to the customer. Now think about that. When do you actually earn the money? You only earn when you have done your job of the transaction or of the contract, and your job happens once you deliver. Then you have earned it, whether the customer paid or not paid, yet you have earned it, and you can record it as your revenue, and you can make a claim on the customer. So you record revenue when you earn it, and you earn it when you deliver a good or a service, not when you receive order, not when you actually receive cash. That is when you should actually be recognizing the revenue. So based on this principle, let's look at one transaction, which is named as accrued revenue, or in simple words, you may call it accounts receivable. So let's look at the simple transaction. You sold inventory costing $800 for $1,000 on credit on 10th of December. That means you have delivered it. Since you delivered it, we are actually going to record sale on 10th of December, although we did not get the cash. So when we record sale, that means we are booking the profit on that sale, even though no cash is received. So here's what will happen. If we look at the balance sheet, on 10th of December, this will happen on 10th December. Since you sold goods, we are assuming that you have delivered the goods. So inventory worth 800 will go down. And in the income statement, this will be recorded as your cost of goods sold. And we'll be elaborating that more when we go into the income statement. And since you're not getting the cash from the customer, you will create another account called account receivable, or you may call this as accrued revenue. The reason it's called accrued revenue is because the money will come in the future worth $1,000. You are going to collect $1,000 in the future. That means you are booking a profit of 200, which will come through the income statement in the form of net income and will flow into the retained earnings, which is part of equity. So we assume that if you're not paying any dividends, the total retained earnings will actually go up by 200. So again, although no cash has been received on 10th of December, but yet the accountant will record a sale and will record the profit even though cash has not been received. This is the accrual accounting concept. Then let's suppose after some days, the customer pays and you receive cash of $1,000 on 25th of Jan 2020. That's more than a month. So you receive that. So how would you account on 25th of Jan? Asset equals liabilities plus equity. Since you received cash now 1,000, cash will go up. And the account receivable which you had created under the customer name, which is the accrued revenue, would now actually be canceled since you have already received money. So this and this would sort of cancel out. This account is no more. If you notice, the accrued revenue account or the account receivable account is just a temporary account. The moment the customer pays the money, this account will actually be closed and it will not be there anymore. And that's the accrual accounting concept. In the accrual accounting concept, you're going to create account receivable or account payable, as we will see in a little while. So this is, you need to know that they could use the term accrued revenue, and you should know that it's actually account receivable, which is money you expect to collect from the customers. And this is recorded in the balance sheet as an asset because you own this. And as you can see, we have been recording it under asset. We can look at an opposite transaction to this. What if we do not deliver and the customer pays us in advance. Keep in mind the principle which we discussed before. Revenue is earned when goods or services are delivered, not when cash is actually received. And this is titled as unearned or deferred revenue, which is a temporary liability. So let's say you receive from customer $1,000 on 10th of December 2019, but you did not deliver the product yet, meaning the customer paid to you in advance. So when a company receives money in advance, what happens? So on 10th of December, there is actually a transaction. However, you have not earned it, so you cannot record it as a sale and you cannot book profit on this money that you have actually received because you have not done your job yet. However, this is a transaction which needs to be accounted for. So let's see how we are going to record this transaction. We're going to say we have received cash worth 1,000, but since we didn't earn it yet, it is going to be a temporary obligation and temporary liability until we fulfill the service or provide the product to the customer. So we create a temporary liability under the name of unearned or deferred revenue. It's a liability account. So we'll create this by the amount of $1,000. What we are saying is, in simple, that it's a temporary obligation on us, which we will cancel once we fulfill once we deliver the goods or services to the customer. So let's say after almost a month, on 15th January, we deliver the goods for 1,000, which had a cost of 800. Now we can actually book the profit, which means now we have given the inventory, which had a cost of 800. So inventory will go down because it went out. And since we have now earned it, we will remove the liability. The liability shouldn't be there. So unearned revenue, which we had not earned before, or deferred revenue, we are going to book the revenue now and book the profit. This would be canceled by the amount of 1,000. So the temporary liability cancels away. And since, as you can see here, we have to book the profit now since we are recording the sale. So through the income statement, we will get the profit or retained earnings of around $200, assuming there is no dividend, and our accounts would actually be in balance. Again, what did we do? We created a temporary liability, and once we delivered the product or service, we actually removed that from our books. So unearned or deferred revenue is a temporary liability, while accrued revenue is actually a temporary asset. So just as we discussed accrual accounting for revenue-related transactions, now we will discuss revenue accounting for expenses-related transactions. So when it comes to expenses, of course, you pay for expenses. Money goes out because it's expense, so it results in outflow. While revenue relates to inflows, money will either today or in the future come in. Related to expenses, you would either pay today or you'll have to pay in the future. So in both cases, there is an outflow when it comes to expenses. All right, so the question arises is, when should you recognize or when should you record an expense? And here are the options you can think of. Number one, when you pay for a service or for a benefit. Is this when you should record an expense? Number two, when you place an order. Or number three, when you actually incur an expense by using that particular service or benefit. And the answer is, you only record an expense when you incur it. For example, if I rent out a building and I stay in the building for 1 month and I didn't pay it yet, even though I did not pay it, I will still record it as an expense because I have already incurred it. If I use a telephone for a month and I didn't pay the telephone bill by the end of the month, but since I have already used it, I have incurred it, we'll be recording the expense irrespective of whether we paid it or not. And if we did not pay it, then it's an obligation on us, it's a liability, and we have to record that liability. So let's look at the first type of transaction called accrued expense or liability. So you rented out a building costing $100,000 per year, and you did not pay the rent by the end of the year. Let's say this is to 2019. So you've used the building, you have received the benefit or a service, and you did not pay it. Since you've already received the benefit or service, we are going to record an expense. And we know when we record expense, then our net income will go down and our retained earnings will also go down. That's the impact on the balance sheet. So let's look at the impact on end of year, let's suppose 31st December 2019. This is what the accountants would do. They would say, since we incurred the expense, let's record the expense. When they record the expense, retained earnings would actually go down by 100,000. which is equity, will go down by 100,000 through the income statement. And since it has not been paid, it's an obligation the company owes it. Therefore, they're going to record a liability, which could be more like a rent payable by the amount of 100,000. And the balance sheet will be in balance. And this is a temporary liability, which will actually be called accrued expense or accrued liability. You may also call it as accrued liability. And in the previous case, when we spoke about revenue, you may call it accrued revenue or accrued asset. Again, this is a temporary liability until we pay it. Let's suppose after almost about 2 months, on 20th of February 2020, this has actually been paid. So when you pay it, cash will go down by 100,000. And since the liability has been paid off, therefore, we are going to cancel the accrued liability or the accrued expense, which we created earlier. We'll reduce this by 100,000 and the temporary liability is canceled away. And this is how you would actually record for such a transaction. So accrued expense is your liability, is a temporary liability. This is when you have used a service or a benefit, but you have not paid it. Let's look at the opposite transaction. What if you pay for a service or for a benefit in advance and you haven't got any benefit yet? Now, to answer this question, let's think of how do we define an asset? What is an asset? An asset is anything that the company owns and expects to derive future benefit from it by either using it in the form of monetary or non-monetary benefit. So you own a vehicle, you believe that you can use it in the future, therefore it's an asset, it will give you an economic benefit. So anything that you expect will give you future benefit is your asset. It's not an asset forever. Of course, it's going to be a temporary asset until you actually expense it. In the same way, when you pay in advance for a service that you have not got, and this service is what you will receive in the future, so there is a benefit that will come in the future, therefore, payment in advance can be recorded as a temporary asset, just like paying for buying a phone would be recorded as an asset because that phone gives you benefit for the future. In the same way, if you pay rent in advance for the entire year, that would also be recorded as a temporary asset until you use the service. So on 25th of Jan, when you make the payment, 2019, this is how we are actually going to record it. So cash goes down, you pay 100,000. Since this is a temporary asset, we call it prepaid expense asset or prepaid asset. Keep in mind, this is your asset. So don't get confused by the word expense here. You're not recording the expense, rather you're recording an asset called prepaid expense. The reason why you're not recording an expense in the income statement is because you haven't yet incurred it. You only incur it when you actually receive the benefit. So let's suppose the year has passed and the year has finished. So you have used the service, you have used the building, and now you have incurred it. And now that you've incurred it, you have to record the expense. And when you record the expense, your net income goes down, hence your retained earnings will actually go down. And since you took the service, that asset is no more, so you have to cancel the prepaid expense asset since it's no more. So you'll reduce this by the amount of 100,000. This cancels against this, and this is what you are actually left with in the accounts. So to summarize, in accrual accounting, you record the transaction when it happens, irrespective of whether the cash is received or whether the cash is received or not, or whether the cash is paid or not. In summary, we can say, related to revenue, accrued revenue is your temporary asset, which is a receivable. So you have delivered the product, but you did not receive the cash. You will receive the cash in the future. While unearned revenue, as the name implies, you haven't earned it yet, or deferred revenue is a temporary liability. On the other hand, when we speak about expense, accrued expense or accrued liability is actually a liability. So you took the service, you took the benefit, but you did not pay it. You will pay in the future. Now in the exam, you're not going to learn all these transactions that I actually showed to you. Rather, you just simply have to remember what is what. Is accrued revenue an asset or a liability? Is unearned or deferred revenue an asset or a liability? But of course, you need to understand that what kind of transactions are actually these. A simple way to remember this is revenue relates to inflow, expense relates to outflow. So accrued means you haven't, the cash is not there yet. The cash will be there in the future. So accrued revenue means you are going to receive cash in the future. Accrued expense means you're going to pay cash in the future. That's why this is a receivable and this would actually be a payable. On the other hand, when you pay in advance, it's called prepaid expense, and that is actually your temporary asset. And with this, we are done with our intro part.